At the height of the pandemic, Arizona's housing market was booming. Home prices shot up over 50%, investors lined up, and bidding wars left locals out in the cold. But as 2025 arrives, cracks are turning into chasms. Mortgage rates near 7%, insurers pull out of risky cities, and investors flee an overheated market. Suddenly, the so-called Arizona dream is starting to unravel, city by city. Which places are facing the sharpest crash, and who gets hurt when a Sunbelt boom goes bust? In this countdown, we reveal the 10 Arizona cities most at risk for a housing market collapse in 2025, and what it actually means if you call one home. Arizona's housing boom did not come cheap. Between 2020 and 2022, the average home price in the state shot up more than 50%. Buyers rushed in hoping to grab a piece of the action before prices climbed even higher. But the math has changed. By mid-2025, the 30-year fixed mortgage rate hovers near 7%. That's nearly double the cost of borrowing compared to 2019, even after adjusting for inflation. What used to buy a $400,000 home now barely covers a $250,000 mortgage payment. The squeeze is everywhere. In Phoenix, Tucson, and Mesa, the typical mortgage payment now eats up almost 50% more of a household's income than it did just a few years ago. According to Freddie Mac, the average Arizona family faces a monthly payment nearly 80% higher than before the pandemic. Wages have not kept pace. Median incomes in Arizona have risen less than 15% since 2019, while home prices and payments have soared far beyond reach for most working families. For first-time buyers, the dream of ownership has faded. In city after city, families who once qualified for a starter home now find themselves locked out. The price-to-income ratio in places like Flagstaff and Scottsdale has hit 8-to-1, meaning the average home costs 8 times the average local salary. Even in more affordable areas, the numbers don't add up. Teachers, nurses, and service workers face the same wall. Monthly payments that swallow their budgets, forcing hard choices about where to live or whether to stay in Arizona at all. The impact is visible on the ground. Open houses sit empty. Sellers slash prices, but buyers hesitate, knowing their dollars don't go as far as they used to. Across the state, families are downsizing, delaying moves, or giving up on buying altogether. The market's foundation, affordability, has cracked. As 2025 unfolds, the economic strain is no longer hidden in spreadsheets or headlines. It's showing up in everyday lives, in every corner of Arizona. Insurance companies are pulling out of Arizona's riskiest neighborhoods. In 2024, State Farm and USAA began halting new policies in wildfire and flood zones, hitting places like Prescott and Scottsdale first. By 2025, filings with the Arizona Department of Insurance show at least 4 mid-size carriers have stopped writing new home insurance in flagged areas. Premiums for homes near fire perimeters or recent flood zones have jumped by as much as 68% in just 2 years. Some retirees now pay over $5,000 a year for basic coverage, if they can find it at all. Many policies exclude wildfire or flood entirely, leaving owners exposed and anxious. State regulators caught off guard tried to slow withdrawals but ultimately approved a wave of rate hikes and non-renewals. The state's emergency wildfire relief pool, created in 2025, covers only a fraction of lost policies and comes with sky-high deductibles. At the same time, investors have reshaped Arizona's housing market. CoreLogic data shows that in early 2023, Phoenix had the highest investor concentration in the country. Wall Street-backed firms like Blackstone and Invitation Homes snapped up single-family homes at record pace between 2020 and 2022, sometimes accounting for over 1 in 4 home purchases in certain neighborhoods. By 2025, these same funds are unloading properties, dumping entire portfolios as rents flatten and regulatory scrutiny rises. Smaller investors, too, have flooded the market. Statewide, 27% of homes sold in early 2025 went to investors of all sizes, a national record. The memory of 2008 lingers. Then, as now, speculative buying pushed prices far above what locals could afford. When the music stopped, forced sales and foreclosures rippled through Arizona's cities. Today, the risk is different, but no less real. Insurance withdrawals transfer climate risk back onto homeowners, while investor pullbacks threaten to flood the market with listings. In Phoenix, one dual-income family lost 12 straight bidding wars to cash investors before giving up and renting. "We never thought this would be out of reach on 2 salaries," they say. Their story is not unique. The cracks in Arizona's housing market run deeper than rising mortgage rates. Corporate risk transfer, investor pressure, and fragile insurance markets are all converging in 2025. The countdown begins now. Which cities will be hit hardest as these forces collide? Prescott sits at the edge of Arizona's insurance crisis. The city's median home price has climbed to $540,000, up 70% in just 5 years. For many retirees, that number alone was daunting. But the real shock came with the mail. Annual home insurance premiums that once hovered near $2,200 suddenly spiked to more than $5,000. Some policies arrived with wildfire exclusions, others with deductibles so high they offered little real protection. A retired couple, hoping to age in place, watched their fixed income shrink under the weight of these bills. In 2025, they sold the home they had planned to keep for decades, moving into a smaller rental with fewer risks and fewer memories. Prescott's vacancy rate jumped 23% year over year, and foreclosure filings are up 28%. Once a haven for out-of-state buyers, the city now faces a wave of listings from owners squeezed by costs they never planned for. Yuma's story is different, but the stress is just as real. The city relies on agriculture and snowbird demand, but both are fading. Seasonal visitors have cut back, and the average local wage, about $18 an hour, can't keep up with a median home price near $350,000. Vacancy rates have climbed to over 6%, a 21% increase from last year. Foreclosures are up 25%. Local workers, many of them young families, are priced out of both ownership and rentals. Lenders report that defaults are piling up in entry-level neighborhoods, especially among homes bought during the last wave of investor activity. For some families, the only option is to leave Yuma behind in search of something they can actually afford. Surprise, on the edge of Phoenix's sprawl, once promised easy commutes and new subdivisions. Investors flocked to the city in 2021 and 2022, snapping up properties and driving values higher. Now the tide has turned. Foreclosure filings in Surprise rose 29% this year. Vacancy rates jumped by nearly a quarter. Many investor-owned rentals sit empty, while young families who bought at the peak find themselves trapped, owing more than their homes are worth. One couple, both teachers, watched their home value dip below their mortgage balance just 3 years after moving in. Selling isn't an option. For now, they stay put, making payments on a house that feels less like a nest egg and more like a weight. The pressure in these cities is mounting, not just in numbers, but in the daily realities of people forced to make impossible choices. Flagstaff's skyline is framed by ponderosa pines and the San Francisco peaks, but the city's housing market is shaped by something less visible: scarcity. With little room to build and strict zoning rules, supply has never kept up with demand. In 2025, the average home in Flagstaff costs more than 8 times the median local income. That's one of the worst ratios in Arizona. Teachers, service workers, and even university staff find themselves locked out, while students crowd into rentals or leave town entirely. The city's vacancy rate has jumped from 2.5% to 3.2% in a single year, and foreclosure filings are up 31%. For many, the dream of living in Flagstaff has become a numbers game they can't win. Tourism once softened the blow. Vacationers filled short-term rentals, and student leases kept landlords afloat. But this year, bookings have slowed. Hosts who once relied on steady summer income now slash prices just to cover costs. One owner who manages several student rentals near the university describes a new reality. "I've dropped rent by 25% and still have empty rooms. Families can't afford it, and students are doubling up or moving back home." City council debates over capping short-term rentals have grown heated. Real estate lobbies push back, but the facts on the ground are hard to ignore. The market is cooling, not just from higher rates, but because the people who built the city can't afford to stay. Lake Havasu City faces a different kind of ceiling: water. The city's boom depended on vacationers, retirees, and a steady stream of short-term rental guests. But the Colorado River's Tier 3 cuts have forced developers to halt new projects, and water restrictions now shape every conversation about growth. By 2025, the vacancy rate in Lake Havasu has surged from 7.7% to 9.5%. Foreclosures are up 26%. The short-term rental gold rush has fizzled out. In 2022, Airbnb hosts in Lake Havasu could charge $270 a night during peak season. Now, industry trackers report average rates as low as $110, with occupancy dipping below 40%. One host who manages 6 properties says bookings have fallen by more than half, even after deep price cuts. Last year, I could count on spring break to fill every house. Now, I'm lucky to get a weekend. For both cities, the limits aren't just financial, they're environmental and structural. Land in Flagstaff is finite. Water in Lake Havasu is running out. As affordability collapses and natural resources tighten, the cracks in Arizona's housing market widen. The next shock will come from the state's largest cities, where the numbers are even bigger and the risks even harder to contain. Mesa's housing market is flooded with listings. By summer 2025, active homes for sale are up 40% from the year before. Walk any block, and the for sale signs line the street. Investors who once drove prices skyward are backing out, leaving their properties behind. Some homes linger unsold for months, while others are pulled off the market entirely. It's a sharp reversal from the bidding wars of just a few years ago. For working families, the numbers are even harder to swallow. In Mesa, median rent now stands at $1,400 a month. That's a 35% jump since 2019, but average wages for service workers have barely moved, up just 10% in the same period. The math doesn't work. One retail worker family, both parents employed full-time, spends more than half their take-home pay just to keep a roof overhead. Groceries, gas, and childcare are squeezed into what's left. Saving for a down payment is out of the question. In Tucson, the pattern repeats. Home prices climbed 60% since 2019, but wage growth trails far behind. Renters face the same squeeze, a median rent of $1,400 against a median income of $55,000. Many spend more than a third of their earnings on housing alone. Legal aid clinics report a surge in calls from tenants facing eviction or rent hikes they can't afford. Glendale, once a magnet for pandemic movers, now grapples with an oversupply of new builds and a wave of distressed sales. Foreclosure filings are up 35% year over year. At the courthouse, families arrive for auction days hoping for a miracle, often leaving empty-handed. The fallout reaches every income bracket. Retail clerks, bus drivers, even middle managers suddenly find themselves on uncertain ground. Scottsdale's luxury market is in retreat. In 2025, homes listed above $1 million often linger unsold for 6 months or longer, 180 days on average, a timeline that would have been unthinkable just a few years ago. Sellers, once confident their desert estates would attract bidding wars, now accept offers a quarter below their original asking price. A $2 million home is quietly reduced to $1.5 million, yet still sits empty as buyers wait for even deeper discounts. The slowdown is most visible at the top. High net worth owners, many with second homes or investment properties, face a market that no longer rewards patience. Price cuts of 20 to 25% are now routine. Some sellers try to sweeten the deal with expensive upgrades or closing cost incentives, but the pool of qualified buyers has shrunk. Cash buyers who once drove the frenzy have stepped back. The result is a growing inventory of unsold luxury homes, each one a symbol of faded confidence. Insurance withdrawals add another layer of risk. After major carriers pulled back from wildfire-prone neighborhoods, annual premiums for some Scottsdale estates doubled. For a handful of properties, coverage is no longer available at any price. Owners forced to self-insure face steep costs and the constant threat of disaster. The mood among realtors is cautious. Even seasoned agents admit that the luxury slowdown is deeper than anything since 2008. The city's high-end real estate, once a badge of Arizona's economic strength, now stands exposed, vulnerable to both financial and environmental shocks. The fallout here is not just about lost wealth, but about the limits of confidence in a market that once seemed untouchable. Phoenix stands at the center of Arizona's housing unraveling. No other city in America has attracted as many investors. By early 2023, CoreLogic ranked Phoenix #1 for investor market share. At the peak, nearly 1 in 3 homes sold in the metro area went to cash buyers, hedge funds, or corporate landlords. Now, that tide is reversing. In 2025, as borrowing costs remain high and rental profits shrink, investors are offloading thousands of properties. Active listings in Phoenix have surged, pushing inventory up 38% year over year, but buyers are scarce. Sales volume has dropped 22% compared to last summer, and homes linger on the market for months. This flood of investor-owned properties is freezing the market. Traditional buyers, already sidelined by soaring mortgage rates, can't compete with cash offers or bulk discounts. Families who spent years saving for a down payment now watch as prices slide, but affordability remains out of reach. The city's once steady stream of newcomers has slowed. Migration into Phoenix is down 30% from its pandemic-era highs. For essential workers, the situation is dire. Teachers, nurses, and firefighters, people who keep the city running, find themselves locked out of homeownership. Their wages haven't kept up. A Phoenix nurse earning $70,000 a year faces a median home price more than 6 times her salary. Even renting is a stretch, with median rents topping $1,500 a month. One firefighter describes working overtime just to cover bills, while his family shares a 2-bedroom apartment. The dream of planting roots in Phoenix is slipping away for those who need stability most. Phoenix has weathered boom and bust cycles before, but the depth of investor control and the scale of today's affordability crisis set this downturn apart. The city's housing market, once a symbol of opportunity, now flashes a warning for all of Arizona. If people who teach, heal, and protect can't afford to stay, the cracks in the system threaten to become a statewide fault line. In 2025, Arizona home prices have climbed over 50% since 2020, while mortgage rates now hover near 7%, the highest in over 2 decades, according to Freddie Mac and Redfin. This documentary has shown how investor pullbacks, insurance company withdrawals, and stagnant wages are driving cracks across cities like Prescott, Yuma, Scottsdale, and Phoenix. Foreclosure filings are up 35% in Glendale, and listings have surged 40% in Mesa, signaling mounting stress. Yet questions remain. How many families will be forced to leave, and will policy changes slow the exodus? What's clear is that essential workers, teachers, nurses, firefighters, can no longer afford to live in the communities they serve. The evidence shows a cycle repeating itself, echoing the 2008 crash but with new pressures from climate risk and affordability. As the state faces rising vacancies and falling home values, the Arizona dream is cracking, and 2025 may be the breaking point.